let's start this part of the analysis by considering what I said at the end of the last video. A bank's IOUs are money, and your IOUs are not, and the chief reason for the difference between the two is that people will take a bank's IOUs as payment for most goods and services, and they'll reliably do so. We all know that people will take bank credit as payment, and we all know that it's quite unlikely that Joe Schmo's IOU will be treated as money by anybody out there. So, banks credit as money because it's widely accepted and regularly accepted and reliably accepted, whereas Joe Schmo's IOU, being no different in kind than that issued by a bank, is not considered money because nobody knows Joe Schmo. Nobody knows if he's willing and able to give bank notes in exchange for his IOU. No one knows where to find him most of the time. He has no electronic infrastructure and all the rest. So his IOUs are not money and the banks are. Now Joe Schmo from time to time will want to own property in things that he can't yet afford. So he'll want to own, an interest in land, or he'll want to own property in the form of ownership of a car, or he'll want to own shares of a corporation. Shares of a corporation, to own those shares is to hold property. That ownership is property. So how does he get those things for which he has no money to trade yet? Well, he borrows the money. And from whom does he normally borrow it? Well, normally he'll borrow that money from a bank. The bank, when it lends you money, doesn't normally lend you banknotes. It doesn't take out a bunch of Bank of Canada notes and give them to you as in the form of a loan. It doesn't take out a bunch of Federal Reserve notes and hand them to you and say just pay them back at the end of the term. What it does instead is it gives you credit in one of many different ways. It either gives you a credit card that allows you to borrow up to a certain limit, or it gives you a line of credit, or could even just literally put some amount of money in your account that you're allowed to then spend and then repay. There's any number of ways in which it can notate the fact that it is lending you money. But what it is lending you is exactly the same in every case. It's an IOU of the bank. That is the general nature of it. A promise by the bank to pay cash to the person who presents the IOU to the bank, to pay banknotes to the person who presents the IOU to the bank. Now, that, in other words, is what the banks do lend out. The banks do lend out debt of the bank, IOUs of the bank. That's what they lend out. Now keep in mind, all loans involve a trade. That's very important to keep in mind. What do I mean by that? Well, when you borrow money, quote unquote, what you're really doing is trading your debt for another person's debt. In other words, everyone knows that IOUs issued by you, debts issued by you, aren't money. Even the bank doesn't think they're money. But for a certain fee, the bank will trade its IOUs, its debt, for your debt. And the fee it charges is normally called interest. So, you issue an IOU to the bank. I, John Smedley, owe the bank $100. And you give that to the bank. You really do that. When you set up a loan, you make a promise to pay. You issue an IOU. You issue a debt, and the bank holds your debt. In exchange, the bank issues a debt for use by you. We, the bank, owe the bearer of this IOU $100. So you've traded $100 worth of your debt for $100 worth of their debt. What have you done? You've traded a debt that nobody trusts for a debt that everybody trusts. You've traded something that's not money for something that is money. You've traded your own debt for the bank's debt. And for the service of letting you use its debts, the bank expects you to first sign over to it an equal amount of debt and to pay a fee in the form of interest on the debt that it's lending to you. So keep that in mind. When you borrow money from a bank, you issue a debt, you hand that debt to the bank issues a debt in the exact same amount and issues it to you. But for that trade, there's a price. The bank charges interest. So that's the nature of the transaction. Now, why the interest? Well, the interest is the fee you pay to be using the bank's good name. In other words, everyone thinks that the bank will honor its debts, so you pay a fee to the bank so that you can be in control of debts issued by a bank. Debts that people regard as money. Debts that people will widely accept as payment in exchange for other property or for services. With interest, in a sense, what you're doing is buying the credibility of the bank. That's why it's called credit. Your IOUs are exactly the same as the bank's IOUs, except that your IOUs aren't credible. Nobody trusts them to be honored. They do trust the bank's IOUs to be honored.